All right, so how do we internalize price delivery? First, we do not trade patterns for pattern's sake. We do not trade indicator readings or momentum. We look to enter longs where retail sells. We look to enter shorts where retail buys. Usually when you hear me say something like that, or someone that's been trained by me speak like that, it sounds like, well, you're talking like you work for an institution, you work at a bank, you're trading retail too. Yes, we are all operating through retail avenues to get to the marketplace. What I'm teaching you is the internal dialogue of what we're doing when we're looking at price. We're not thinking like the collective that is commonly referred to as the retail trader, because majority of retail traders lose. They have a failed logic. They don't have consistency. They don't have, longevity. So we want to try to think and engage differently with price that is opposed to the majority of what retail analysis, concepts, whatever it is that you subscribe to as a retail trader. All those things, unless they're rooted in the basis of liquidity and order flow, it's made up. It's a religion. And I'm not here to argue beyond that. That's what I have come to believe, and that's how I operate. And my results and the things that my students see speak for themselves. We anticipate price seeking opposing liquidity. Okay, so what does that mean? Well, if you're looking at this diagram, imagine if we could take price as a conceptual idea. It doesn't matter what market it is, but let's just say there's two camps. There's the informed or smart money, and that's represented by this small little circle over here. And then there's a larger collective, which is the speculative uninformed money. There's a large influx all the time of new uninformed money coming in, because there's a large influx of uninformed money going out because they lose their account, they blow up whatever equity they have in their trading account, it's gone because of lack of discipline and a flawed logic. Smart money traders, when they look at the marketplace, they're not looking at secret trading indicators. Okay? There is no secret indicators. Just let me put that to bed right now. Now, there may be traders that have tools, okay, that they like to measure price action with. That's not like a stochastics. It's not like an RSI. It's not like anything you can find on a trading platform, list of indicators, okay? Those things are not reached for by informed money. What they're specifically looking at is time and price. The most important thing is time, because time, that is the most crucial element. So time of day is vital when we're engaging price. Retail doesn't really have any understanding or affinity for time, except for the fact that they have time now to trade because they're in front of their computer, or they have time to look at their phone while they're at work and they're putting on trades. Okay, that's the extent of time when it comes to a retail average trader. Time for a professional, through the lens of smart money, time is crucial, because time of day, there are specific elements in a daily range that really build the likelihood of volatility to come in, and also when short-term reversals are likely to occur. Okay, so I mentioned in previous lessons that there's algorithms that will start to gyrate and cause price to run at specific times of the day. If you were watching the E-mini markets today, you saw it happen at 4 o'clock. That was one of the times I gave, and it was relentless today. Smart money, so that way I can make this real short and to the point. Smart money looks to cannibalize this group of trader. So because they're typically wrong in their directional bias, in their stop placement, should they choose to use one, because a lot of traders don't use a stop loss as a retail trader because they're afraid. They may expect the market to go lower. And they understand that the highs above where they're at, if they're in a very small window of profitability, unrealized profit, that means they're still in the trade, but they don't have a stop loss in. Now, logic dictates that they should have a buy stop in to protect their position in case the market screams against them. At least it limits the amount of equity lost. But they may look at an old high and say, okay, I understand that my stop should be above that, but because of their infancy, they have no idea where to put it above that high. They don't want to put it too shallow because it might go up there and hit it and stop out their trade prematurely. Or they don't want to put it up too high and then it spikes through that and reaches for them and then it reverses and goes in the direction they were holding. So they take a big loss and get stopped out. So those are the two conundrums that a retail trader falls into, that pitfall, that trap. And maybe you're nodding your head and smirking, thinking, man, I was there a lot. I know, and I can admit, back in the 90s, 1992, 1993, that was what I was doing all the time. I just didn't know what I was doing, and I was falling victim to myself and just infancy, not knowing. But the smart money traders are not looking at price with, give me a pattern to trade off of, a bull flag, a wedge pattern, something to that effect. They're looking at liquidity. What is the underlying narrative right now in the marketplace? Is it bullish? Is it bearish? Is the day's daily range going to go higher? But how's it going to go higher? Is it likely to go lower at the beginning of the day first to sucker traders in going short? Run out sell stops they can acquire long positions at and then rally going into the close or maybe into the afternoon. And that would be the extent of their plan of action. And how does that speculative uninformed money and its liquidity that it provides, how can they utilize that? That's the market efficiency paradigm. It's efficient for smart money traders to view the marketplace in that perspective versus technical analysis, the mumbo jumbo things that traders put on their charts. Okay. And you can lump me in there too, because the times where I'm trying to use the logic that I trade with, and if it fails, I've done something wrong. I've interpreted price wrong. I thought something was in price and it wasn't there, and it rolled over top of it, and there it is. And that's a loss. Everybody's going to have a losing trade. Okay. But I'm not looking at price with patterns on the sake of just trading for the pattern's sake. In other words, just because I think I see a pattern there, because there's a misnomer that goes around, trade what you see. Well, just like the trend is your friend. That trend is not your friend when it's at the end and it's reversing. Okay? So there's always a rule to the rule. There's always an exception to every rule. Okay? And that's experience. But what I've hopefully done in this model so far, and I promise this is the end of the boring stuff, we'll get into the nuts and bolts. I'm stripping everything down and placing components at their logical place and order, so that way you can go in the price immediately. You don't need 18 months. You don't even need 4 months. It's immediate. I've received a ton of feedback, and I appreciate all that you all can go into the charts and see these things right away. And some of you actually started trading it. I'm not asking you to do that. I'm not trying to inspire you to do that. You need to study it more. But that's how quick and different all this is. Okay, this is not your typical ICT, the stale, boring stuff. This is the things that really work in the marketplace. So with that in mind, let's continue. So I want to give a little bit more specifics about the fair value gap. That way you have the rules, what it looks like, so that way you understand exactly what it is and where it forms. Because this is going to repeat. Every single time, it's going to be the same logic that I'm going to show you here. Okay? Do not try to fancy dance this, okay, and try to turn it into some kind of a mentorship course and rename everything with your name. And don't do that. Okay? Just take it for what it is. I already know people are going to try to take this and copy it and make courses out of it. Okay? I've already given it to you for free. If it helps you, then God bless you. Okay? Okay, and all I'm asking for is just appreciate the fact that I've taken the time to put it out here for you. So the bearish ICT fair value gap. This is institutional order flow, and it's a pattern that you can see the order flow actually coming into the marketplace. When you look at like depth of market, okay, or if you study volume profile, that's a religion, okay? What you're looking at is data, yes, but your interpretation is a private interpretation. It's what you believe. There may be a lot of other traders that have a similar mindset about that very thing, but simply because you think that doesn't make it true. It doesn't, okay? So what I'm trying to do is take my students into the marketplace with a chart, a time-based chart. Okay, there's some out there that will say time-based charts are useless. That's because they don't know how to use a time-based chart. Because algorithms, the first element they operate under is time. Hello, quants. So we're looking at what does a bearish ICT fair value gap look like? Well, if you take a look at this diagram, it's rather crude, I know. But you have a run, preferably above some kind of an old high. So the first candle is the high, and the next candle is the extended low that goes below it. And the third candle is another continuation candle, but the main important factors are this. It's a 3-candle formation. The first candle's low has to be traded below on the immediate following candle. The next candle has to trade with an extended low as well that went below candle number 2, but does not trade with a high that trades back to candle number 1's low. What that creates is this small little gap where one candle only traded from the range of the candle number 1's low to candle number 3's high. So that little space that's occupied right there, what is actually occurring there is price is only being offered on the sell side there. So imagine if you're painting your wall at your home, okay? And you take your roller, you put it in the paint, and you put the paint up against the wall, and you roll down, okay? At first, the first foot or so, there's going to be an ample amount of paint delivered to the wall from your paint roller. But then as you keep rolling down towards the floor, what will happen? You'll start seeing these little pockets that look really porous, okay? What do you have to do to fix that? You just change directions and start rolling the paint roller back up, the same place you rolled down. That's exactly what price does. There's an algorithm that delivers efficient market delivery. You can argue with me all you want. You're not going to convince me. I know it. If you go into price action with that market efficiency paradigm perception of looking for this characteristic in price, I promise you, you will never look at charts the same way again. It'll unlock a lot of things. Remember the movie The Matrix? And Neo finally sees the Matrix as it really is in binary code, 1s and 0s. He has clarity. Well, that same event, as silly as it may sound, ends up happening when you look at price action, when you start looking at it from this perspective. So let's go back into that analogy with this. Between this candle's low and this candle's high, we only have sell side offers. So that's like taking the paint and applying it to the wall and drawing down with the roller. But now as you pull down, there's little pockets right in here between this candle's low and this candle's high where price has not been efficiently offered for buyers. Why? How's that working? Well, you have sell side being offered here because the market's delivering lower prices. It's offering continuously lower prices between this candle's low and this candle's high. To efficiently balance out that little inefficient area, at some future time, the market's going to want to trade back into that area. When it does, and you're bearish, that's a short signal. Okay, you can go short and sell there with the expectation it's going to start to move lower. Optimal formations of the bearish ICT fair value gap will be found after a run into buy side liquidity. So it's not a matter of going into charts and looking for this little gap all the time. This model I'm teaching you on this YouTube channel is meant for you to look for periods where price runs above an old high. Then it breaks down, and then you look for this pattern. This is what it looks like. You're not looking at anything prior to this candle. Has absolutely nothing to do with anything except for the fact that we traded above an old high. That's a very simple logic, isn't it? And the run above a single high or multiple highs, like a double top, okay? Either one of those fits this criteria. So what you're looking for is a pool of liquidity of buy stops. Resting above these highs, that's buy side liquidity. Smart money will want to trade up into that and go short. They may not be engaging above the high. They may miss it, just like any one of us that haven't been ready to take an order and place it in the marketplace. They may miss that. This is their saving grace right here, this pattern. That's what smart money is looking for. They're looking for that right there. And then once they see that, they go in either with their limit order, mark it in, something to that effect, and get short, and the stop would be above the high. Okay, there you go. Short and sweet, done. That is exactly what you're looking for a fair value gap. So when you're doing your annotations on your charts, this is what you want to be doing. All your back testing, label number 1 candle, the number 2 candle is always going to be where the gap resides. And then the number 3 candle gives you the lower end. The upper end of the fair value gap is going to be the low of candle number 1. The lower end of the fair value gap is going to be the high of candle number 3. And the difference between candle number 1's low and candle number 3's high, that's the fair value gap. So the easiest entry would be trading just above candle number 3's high. You can put a limit order right there and be done. Simple. Don't have to worry about guessing where to put your limit order in. It's right there. Place your stop right above candle number 1. Or you can put it above candle number 2. But while you're learning how to use this, that may seem like a lot of range. You want a lot of range when you first start out. I'm assuming that all of you are brand new. You may not be, but I'm teaching it with that perspective in mind. Some of you that have been with me for a longer time, you know how to reduce that stop. And I know hearing that by some of you that are new, you feel like you're being slighted. Oh, you're holding back. No, I'm protecting you, because I know already some of you already are going out there trying to trade live money, and you may be reporting you're doing good, but you don't know what you're doing yet. Okay, just trust me. You got to practice and do a lot of back testing, then demo it. Then you'll get it. The bearish market structure shift. What does that look like conceptually? Well, you have the market trading higher, short-term little retracement, then it trades above an old high or the initial short-term high that it trades above here, and then it breaks down. Once that low is broken, that's when the new trade idea is now being birthed. You don't even know where you're getting in at yet until you go through this process I'm going to show you right now. The market will see a price delivery of a rally above an old high or highs and then quickly shift lower. That's this right here. Now the significance I'm placing on the term quick is linked directly to the term displacement. Okay, it's got to be energetic. It can't be a little lethargic little move. It's got to show a real willingness to want to go lower, and preferably close below that. If it does that, that to me is a little bit more significant. Whereas if we just go through this low a little bit like a wick and come back up, that to me is not all that convincing. I want to see that it has absolutely displaced and then the candle closed, and then we look inside this range here. So when you're looking at market structure shifts, this is all time frames. So don't think this is just the intraday version of it, but I'm specifically dealing with intraday. So when we create that high, that high down to the low that breaks the short-term low here. So now we have that shift in market structure there, right below that low. That is the displacement low. This is your displacement high. So what's the big deal about that? Oh, you're just trying to add some words, ICT. You sound smart that way, don't you? No, it's conceptual ideas being expressed. So what you have in between that range, that right there, you're going to be hunting your fair value gaps because that's exactly where it's going to form. Don't take my word for it. Every one of your examples are going to have this. Oh. Don't take my word as the only thing to believe. Go into your charts and you will be convinced of it in short order. Period. So if you're bearish and you see price run above an old high, then it breaks below the old high and takes out a short-term low prior to that run above. That short-term low being broken, draw that out in time. That's your displacement low, and the high is your displacement high. So that range between here and here, that's displacement. How do you know it's displacement? How it closes down here below that low. Is it just a real short little drop below it? It might have a fair value gap, but it also might be likely to go higher and create another high. So this is the secret to it here, knowing how we trade below that, and if it's energetic, a lot of movement, a big beefy bearish candle that closes low below this level right there. Okay, if we have that, as soon as we have that candle form, start watching to see if it creates a fair value gap in between this low and this candle's high, or that range. Okay, that's exactly where the fair value gap to sell short will form. If there is no fair value gap in here, guess what? You don't have a trade. You wait or go to another market because one of them is going to be there. Every single trading day, okay? Every single trading day, this pattern forms. Are you telling? Yes, I'm telling you just like that. Every single trading day, this pattern forms. Every single day, long and short. But you have to look for it with this process, okay? Everything I teach obviously is reversed the same way, so I'll just go through this a lot quicker because this is already becoming a longer video than I wanted it to be. But bullish ICT fair value gap, again, institutional order flow pattern, and it's 3 candles formation. The candle here is number 1, the second candle here, and the third candle there. Candle number 1's high, that is the low of the fair value gap. Candle number 3's low is the high of the fair value gap. Candle number 2 is where the fair value gap will be formed. So that is your fair value gap, and everything you would expect to see in form of a market run below an old low or multiple lows for sell side liquidity. Once it starts trading higher and takes out a short-term high, that's not being shown here, okay, because I'm showing you the pattern itself. This is what you're looking for, okay, this separation between 3 candles. That's the criteria. You have to blend in the logic of a market structure shift that's bullish. So what does that look like? You have a market trade below an old low and maybe go another leg lower and create a run into sell stops. Once that occurs, then you're looking for a run higher that takes out a short-term high and it closes above it with an energetic displacement higher. Once you see that, then you have a trade idea being birthed. You don't have a trade entry yet until you determine if it has a fair value gap. Where does that reside? Between the displacement high and the displacement low. In between, right before the market structure is broken bullishly, and the low that ran into the sell stops, that is your range. This is exactly where you're looking for a fair value gap. So in that range, that's where your bullish fair value gap resides. If there isn't one there, you don't have a trade. Is that not specific and clear? It's perfectly illustrated. There's no ambiguity to it. It's exactly the logic you're going to use. Going forward, it does not change. It doesn't mutate into anything. You don't bring something else into it. You don't add something else that some other educator's taken my stuff and twisted it up and tried to make it sound like something new and they've created themselves. No. This is what you're supposed to be doing. If you do anything other than this, you're not going to get the results you're looking for, and you're not going to find my ICT fair value gap. Okay?